Okay, let's get into it. Calculating channel and customer profitability, the heart of this presentation, now that we've sort of got the basic primer behind us. Those of you who may have taken my earlier course, my initial course on analytics-based enterprise performance management, know that I described 8 forces that have caused interest in enterprise performance management methods. Because as I mentioned in that course, EPM or corporate performance management, which are synonymous, it's not really new. It's basically the integration of existing methods people are already familiar with. Not few companies have implemented all of them or even some of them. Well, one of those 8 forces was this one, the shift from being product-centric to customer-centric. And that's what we're going to discuss the rest of this presentation. The value of a company is a function of the value from customers. The only value a company will ever create is the value that comes from its customers, the current ones and the new ones acquired in the future. So to remain competitive, one must determine how to keep customers longer, grow them into bigger customers, make them more profitable, serve them more efficiently, and acquire relatively more profitable customers like your existing ones. But there's a problem. There's a couple of problems. One, most accountants are not measuring customer profitability. They stop measuring only at the product gross profit margin line. They don't go below it for the selling, distribution, customer service, and the like. And the second problem is the sales and marketing team typically has 2 goals: grow market share and grow sales. They need to shift their mindset to grow profitable sales, because not all large customers are automatically the largest in profit, as we will see later in this presentation. So, what about all the below the line calculated cost, below that product profit, gross profit margin line? Products and standard service lines are not the only thing for which accountants should compute costs for. What about all the costs that have nothing to do with making products or delivering standard service lines? The problem with accounting's product gross profit margin line reporting is you don't see the bottom half of the picture. And I'm going to make a case that the bottom half is much more important than the top half. The top half is that, gross profit margin, but the below that is really the selling, marketing, and distribution. Visually, here is a fictitious income statement. So notice that the sales minus the direct costs and those indirect overhead costs gives a gross profit margin of only 70. And it would be nice if that $10 was assigned to the products correctly. But the real issue is this: below the gross profit margin line is selling, distribution, marketing, customer service. And you look at the numbers, we go from $70 profit to 10. There is no visibility to those costs by individual, except in grand total. So ABC used below the product gross profit margin line will basically address how to do this and get the true calculated costs. Here's a visual way of what I showed you in the previous income statement. The product costs are just the shaded spot: direct material, direct labor, indirect expenses. And if you're in service organizations, you have similar opportunities. But what about when we go bring in the distribution, the selling, the marketing, the channel related expenses, and then the specific ones unique to customers, customer service, returns, and the like? The white space is what's much more important than the shaded space. So why is that white space more important? I call this the perfect storm, the what are called the cost to serve, customer related costs. Here are 4 reasons it's important. First, customer retention. It is relatively much more expensive to acquire a new customer than to retain an existing one. That's sort of a no-brainer, because your existing customers are already, you have them. And if you know decision theory, any sunk cost or existing cost is not applicable for the future. Next, sources of competitive advantage. As products and standard service lines become commodity-like, then the shift is towards service differentiation. So what do I mean? My belief is this: Today, customers view all suppliers as commodities. They basically provide the same types of products, or banks have the same types of deposit accounts or checking accounts. And if some of you are saying, oh, well, we're actually very unique with our own product, I just say, well, let's wait a year or two because competitors are very good at, at copying. So if the products and service lines are commodity-like, then the shift must be towards different service differentiation. We'll now see the next two forces. The third storm is customer relationship management's one-to-one marketing. In the 1990s, Martha Rogers and Don Pepper wrote a book on customer relationship management one-to-one marketing. And in my mind, it was the death knell of mass selling. It was no longer, have research and development, create a new product, and have the salespeople go push it out. It was work backwards, knowing the unique preferences, traits, and characteristics and ideals of customers and tailor the various marketing offers, deals, discounts, price discounts, what have you, to them. Next, and finally, the power shift. The internet is shifting power irreversibly from sellers to buyers. This is a one-time event happening in our lifetime. And I don't just mean, individuals like you perhaps shopping on the internet. Today, purchasing agents with a click of a mouse can see 30 suppliers and all of the products and services and pricing about them. So when you have these four forces of the perfect storm, and probably a dozen more if this was a workshop with flip charts, you realize we must know a lot more about how customers interact with us and what the actually monetary view of that is. Now, this is an intimidating diagram. I won't go through it. It's a decomposition of that piping diagram, the multi-stage cost assignment network that I showed many slides earlier. But the point is this: when you sequence the activities from left to right, you're basically subtracting cost after cost after cost, and so you're effectively creating margins that are like an onion skin. And this gives that ability to basically create a profit and loss statement by each customer. And here is an example of a customer profit and loss statement for an individual customer. Now you'll notice at the right that there is a 30% profit margin on just the products. And it's currently a mix. It's a composite average because some could be higher or lower. But between the 30 and the 8 at the bottom, 22 more points of margin are eroded that have nothing to do with making the product or delivering the standard service. It's all, if you will, channel distribution, selling, marketing, customer service, and the like. And so if you were to calculate for every customer those two broad swaths, we will get a grid matrix that I'm going to show you in the next slide. Here is the matrix that I referred to you. All of the individual customers are the intersection circles inside the box. The vertical axis is the product mix margin from low to high for what the customer is buying. But the bottom half is basically low maintenance customers on the left, high maintenance customers on the right. That's part of the issue because you do have high maintenance customers, always returning goods, never buy special, only buy never buy standard, only buy special, changing schedules on you, and the like. The low intensive, low demanding customers, you love them. Only buy standard, never shift schedule, never return goods, never call help desk. That makes a big difference. So when you calculate and put them on this grid, things become obvious. The most unprofitable customers are in the bottom right because they're buying low margin mix from you and they're difficult to serve, demanding to serve. The most profitable ones are in the upper left because they're buying high margin mix from you and they're easy to serve. And so the name of the game is move the dots. And we'll talk about some of the ways, the actions one can take to move the dots from the bottom right to the upper left. I do want to make an observation that some of the really advanced companies that have implemented customer profitability are going one step beyond. They are altering the commission structure for the sales force from being exclusively 100% sales volume to a blend of profit and sales. So for example, it could be 60% revenue and 40% profit for each individual customer. And when the sales director sits and has the account planning meetings with the various salespeople, they will talk about, well, what will your target be for the next 6 months or a year later? And I can share with you that salespeople get it because they understand this is how they make their bonuses and commissions to feed their families for their household. And they will learn how can they alter the behavior of their customer in harmony with the expense structure. So for example, if we're delivering to a location of a customer 5 days a week, and with partial skids and partial truckloads, what if we can persuade the customer to have 3 deliveries a week, same volume, but with full skids and full truckloads? That's in harmony with the expense structure. And what this is doing then is it's basically connecting the sales customer's value to the shareholder value. And that bridge is broken because the accountants are not calculating below the product gross profit margin line. Another way to look at the same information that was on the grid is the same data points, but in a different format. Customer sales volume versus profits. The vertical axis is the profit level reported for each customer. Above the zero is positive, below is negative. The horizontal axis is the sales volume. So notice at the very far right is a very large sales customer. Above that are a few other customers, a little less sales, even more profit. But the scary part is below. We have some very high volume customers that are unprofitable. And so the point is this: sales volume is not representative profitability. They don't go hand in hand, which is why we need to have that information to start generating the needed questions. How do we move customers from being less profitable to more profitable? What's really happening here is there needs to be a shift in the CFO's emphasis. I humorously say the CFO typically does two things. They basically give reports to the executive team and the board of directors, and they pound on operations to lower their costs. They need to do a third goal, which is help sales and marketing better target customers. Spending budget for sales and marketing is critical, but it should be treated as a preciously scarce resource to be aimed at generating the highest long-term profits for shareholders and owners. So this means answering questions like, which type of customer is attractive to newly acquire, to retain, to grow, or to win back, and which types of customers are not attractive? And more, as important, how much should we optimally spend attracting, retaining, growing, or recovering each customer microsegment? Notice I use microsegment because people are getting more, marketing people do segment in greater granularity. It's no longer a grid, male, female, old, young. They may have 20 or 30 microsegments. And so the question is, why is it optimally spent, which is in italics in this slide? The reason it's an optimization problem is this: you can destroy shareholder wealth creation by overspending unnecessarily on loyal customers for what is needed to retain them. You're basically over-serving them, and they wouldn't have changed the volume and mix that they were buying from you anyway. But in contrast, you can be underspending on marginally loyal customers and risk their defection to a competitor. So therefore, what is the optimum spending level for differentiated services to different microsegments of customers? We're back to what should be the optimal price discount, offer, deal, and so forth, because it is kind of a bell-shaped curve. You can underspend, it's bad. You can overspend, it's also bad. There is an optimum for each of the microsegments, and the accounting department, who is savvy and has more skills than just closing the books and doing the journal entries, can basically now help support sales and marketing with the intelligence of how much that level of spending should be to, if you will, increase the ROC. I didn't say ROI, return on investment, ROC, return on customer. Now, I realize that the financial view, the monetary view, is not the only consideration. There are other factor variables to evaluate sales prospects and existing customers, and they should include, retention, attrition, the churn propensity, And then what's been called what is the RFM acronym, recency, frequency, and monetary spend. Some companies use that technique as sort of their way of putting value on attention to customers. But think of that as a primitive way. What we're talking about in this course is a much more sophisticated way. And there are the life cycle stages. Where is the customer early in their stage? And there are techniques called customer lifetime value, which you're more than welcome to communicate with me about the referral potentials, the family relationships, the niece is at this bank and her rich aunt is at another bank. Maybe the niece can convince the rich aunt to come to her bank. Tastes and preferences, social media, Facebook, and the like. So I'm not dismissing that they're not these other factors, but money is the language of business. And when you put things into monetary terms, people will make better decisions. So, what are the actions to make customers more profitable? And this will be a quick laundry list. Manage each customer's cost to serve to a lower level. Improve and streamline the customer-facing processes, including self-service models where possible, where the customer is basically doing the work that you normally would be doing, like kiosks at a hotel check-in. Establish a surcharge for or reprice the expensive cost to serve activities. To move those dots, remember, from the bottom right to the upper left, if there is a high demanding customer with special services, give them a surcharge, similar to the way the freight companies have 1-day, 2-day delivery. Reduce services. Focus first on labor intensive ones that add the least value yet cost the most, that may not even impact the customer in terms of their buying habits from you. Introduce new products and service lines. Abandon old products and service lines. That's always a challenge. Companies never know when to give up. Raise prices. Good luck. That often is not possible, though, in a competitive environment. Improve and streamline the internal business processes. Yes, that's where the lean management, Six Sigma people can basically reduce the cost of the processes that go into the products. Offer customer profit positive service level options with varying prices. I mentioned that when you alter the commission structure for the salespeople, like that 5-day delivery with partial skids and partial truckloads to 3 days with full skids and full truckloads, you could even offer a 1% discount as an example. But as long as the incremental change in the price is superior to the incremental savings in the cost, it's a good move for the shareholders. And increase investments on activities where a customer shows a preference for, and then upselling and cross-selling the mix. If they buy a set of golf clubs, can I sell them a golf shirt? If they buy the golf shirt, can I sell them a second shirt at a discount? These are just a few of the actions to move those dots in the grid, the matrix from the bottom right to the upper left. And finally, discounting, but you've got to be careful with the area. Here is a diagram from the Martha Rogers that I referred to earlier that I find appealing. What you see are distribution curves, where to the far left is really the unprofitable or less profitable customers. At the far right are the more valuable customers. The vertical axis is the number of customers that the company has. So start with number 1 line, the distribution bell-shaped curve, as the baseline. Where the sales force typically wants to go is to the curve number 2. Let's just get more and more customers, sell to more and more. But with the information we're talking about here, we don't necessarily have more customers. We need more valuable customers. So we're really looking for the distribution curve to the right. Only focusing on the number of customers acquired results in a degraded mix, as low-value customers, by definition, are easier to acquire. A customer-centric strategy will not acquire any customer, only higher-value customers.